Welcome again to this first session for the introduction to the financial accounting. So today we are going to define what is a financial accounting. So my good learners, financial accounting, or simply FA, is a process of identifying, comma, classifying, comma, recording, classifying, comma, recording, and once you identify, you classify, you record, you summarize, or you can say comma, summarize, comma, and communicate to the intended users. So that is what the financial accounting means. It first to identify that the transaction has taken place. Once the transaction has taken place, you have to classify this transaction, whether it is an expense, it is an income, it is the capital, it is the liability, or it is an asset. So once you know these classes, then now you are in a position to record either in a debit or a credit of all these classes of the transaction. And then you communicate to the intended users. Who are these users? The owners of the company. We'll still talk about the owners of the company, for example, the customers, for example, the government, and also the suppliers. Those are the users of these financial records. Now, then after that, we need to see the objective of financial accounting. The objective of financial accounting. Why do we need this financial accounting in first place? Why do we need this financial accounting? We need this financial accounting for future reference. So that if the company wants this information in 10 years in future, they can find it because we have the records. So we need to keep the records of this financial information for our future reference. Number two is for the company valuation or the performance evaluations. You cannot evaluate the performance of the company if you don't have profit and loss account. You need to have the profit and loss account so that you can be able to know whether this company is making a profit or it's making a loss. So which means this record is very crucial for those people who evaluate the performance of the company, the performance of the company. Number three is for the purpose of audit. If we define what is an audit, let's even start first by defining what is an audit. Audit is a process of examining the financial statement. So you cannot examine something which is not there. So you need to have the record first for you to do what? To examine. So this financial accounting will help us to execute the audit. It will help us to execute the audit. So these are just the main objective of the financial accounting. It is not limited to this. I'm just giving you just a few examples. So once you know the definition, the objective, what else do you need to know? You need to know the accounting equation. The accounting equation. So the accounting equation is an equation. Say is an equation that equates the assets, comma, liability, and capital, and capital. So it is used to equate the assets, liability, and capital. So don't mind, we will look at in detail in form of the balance sheet, because at the end of this financial accounting unit, you will be able or you will be in a position to do what? To prepare a financial statement, specifically balance sheet. And the balance sheet is the one which it uses the application of this accounting equation. So having done that, the definition, the objective, and the accounting equation, now let's look at the elements of the financial statement. So write elements of financial statements. Elements of financial statement. So in simple term, when you say the financial statement, this is a component of what makes this financial record to be called the financial information. So we have an example, the ledger. We have the ledger. This is an account which we use to record either an individual transaction or a personal transaction. A good examples, we have the sales ledger account, and the purchase ledger account. So once we record this in the sales ledger or the purchase ledger account, then we transfer it. We have another one called the general ledger. A general ledger is a ledger which records all the transaction. So this one, it doesn't specify whether it is an income, it is an asset, or it is a liability. So it records all the transaction of the company. We call it general ledger. From the word general, you can easily tell that it records all the information of the company. And then number three, we have the P&L. The P&L in full. The P&L in full is just simply the profit and loss account. So this profit and loss account is used to record. Expenses and incomes. It is used to record expenses and income. It is used to record the expenses and income. So at the end of the day, this P&L is the one which will tell us whether this company is making a profit or it is making a loss. And then thereafter, we have another one, number 4, balance sheet. The balance sheet will remain the same name, but the policies or the standards of this financial accounting keep on changing. But the balance sheet will remain to be the balance sheet, but now we call it the statement of financial position. Statement of financial position. It's still the balance sheet. So this one, it is used to record assets, liabilities, and capital. Or another name of capital is the equity. So it is used to record the assets, liabilities, and capital. So these are the just 4 statements of or the element of financial statement. So as an accounting student, this will make the root of your accounting career. You need to understand what is a ledger. How do I classify this ledger? You have a sales ledger, purchase ledger. You also have the personal ledger, or what you call the nominal ledgers. And then we have the general ledger. If you are using me, I like teaching again, giving a real practical example of accounting. If you are in a practical field, we use the software. This software, we call it accounting packages. So, for example, if you are using QuickBook, then in the QuickBook, if you go to the report section, you can be able to see the report or a drop down for the general ledger. If you click that general ledger, you'll be able to view all the transactions of a company given a certain period of accounting. So all this is what we need to know. So once we done with this, we need to know the accounting standards. Let's see the accounting standards. Accounting standards. So we can start by defining definition. So you say these are these are policies and procedures that govern. These are policies and procedures that govern accounting or financial reporting, in short. Financial reporting. So every debit and credit, there must be a standard which governs this one. So say also they are classified into two. They are classified into two. Number one, we have the standard which is used for the public sector. So we have for the public sector or the government entities. And number two, we have for the private sector. So in the public sector, we have what is called the IPSA, the Public Standards Accounting Board. We call the Public Standards Accounting Board. So this is which it is being used by the government entities or the parastatals. That we have for the private sector, we use IAS or the IFRS. That is International Accounting Standards or International Financial Reporting Standards. These are the two. They are being used interchangeably. You find that when the IAS 1 is being replaced by IFRS 1. So you also need to know these standards. So why do we need these standards, or the reason for us having these standards? So let's look at the objective of accounting standards. Objectives. So the first objective is to promote uniformity. The first objective is to promote uniformity. This standard was introduced so that all the accounting standards to be uniform. If you go to the UK, they're using IAS 1. If you come to Kenya, they're using IAS 1. If you go to TZ, they're using the IAS 1. If you go to Spain, they're using the IAS 1. So this standard is uniform. So, and debit and credit, what I really love with this accounting is that all the principles will remain the same, regardless of where you are. Number two is to help to interpret. Yeah, just write that. Interpret the accounting concept. The accounting concept. So remember, this financial accounting you will only get in the field of business. And in the field of business, there is always a conflict. You will get a conflict either between supplier and the company, either between the government and the company regarding the taxes and the accounting principles. So if you go to court, the court will be determining your case using these standards. So this standard will be a guiding tool to the users, or not the expert of the one to prepare this statement, but the users. Remember, the users, they don't really understand what is an accounting, but if they can't get this document, they will be able, or they will be guided by this document. They will be guided by this document. So those are the two examples or objectives of the accounting standard, So once we are done with this, then we need to look at the users of financial. So let's see the users. I had said this before. The first one is government. Why does the government need this financial accounting? Number one, or an explanation, is that we need this financial statement for them to ascertain the profit of the company. They want to ascertain the profit of the company. So once the government ascertain the profit of the company, then you know what will happen. They will take the portion of their share, or you can say so as put a comma, so as to take their portion, their portion. It depends where you are. All these rates keep on changing depending with the country you are. For example, when you're in Kenya, you take 30% of the profit. Take 30% of the profit. Number two, user is the customer. I always tell people, without a customer, there is no business. Without a customer, there is no business. So even this customer is concerned about your business. Why? Because if you are not existing, this customer will not exist also in the other end, because it has to supply, it has to take goods from your own business or from your business, and then it will go and resell to other customers. So if you don't exist, then this customer also will not exist in terms of business. Also in terms of consumption. So if you will be no longer producing goods, this customer will not get anything to consume. So basically, the customer wants you to ascertain the going concern of the company. So you say to ascertain, or to get to know, to ascertain the going concern of the company, the going concern of the company. So when you talk of going concern, is an accounting principles which state that the company should continue in future without showing the ability to liquidate or to be closed up. So it is that principle which states that the company should always continue in foreseeable future. Number three is the supplier. So why the supplier needs this statement? To know or to ascertain whether the company is able to pay their due. Whether the company is able to pay their due. So when you are in business, you will not always buy in cash. At one point also, you buy goods on credit, and then you will agree with the terms with this supplier that you will pay this one maybe in 30 days or in 60 days. So this supplier is so keen with your statement whether to ascertain your level of current assets, whether this level of current assets can be able to cover my due. And if you have done, or when you go ahead, or when you proceed to do this CPA, you realize you will do financial ratios. So the financial ratios, we have one financial ratios which is key for supplier, and that one we call it the current ratio. The current ratio is a ratio which is used to measure the ability of the company, whether it can be able to cover its liabilities using their current assets. And then number 4, which is the user, is the owner. Is the owner, or in simple term, the shareholder. The shareholder. The shareholder. So this shareholder wants this report so that they can be able to see whether there is a ROI, or there is a return on the investment. They want to know, or they want to ascertain the ROI. The ROI. What is a ROI? What is a ROI? So ROI is simply the return on investment. The return on investment. The return on investment. They want to know whether they are really maximizing the wealth, because the main objective for you being in business is to maximize the wealth. To maximize the wealth. So those are the users of the financial accounting. Examiner will not ask you more than 4. Examiner will not ask you more than 4. So that is it for today. Make sure that you read this accounting or this session of ours in a logical manner. So finish first with the introduction and then go to the next. So don't jump to the last one before finishing this one, because you have to build this concept on a sequential basis. So let's meet in the next session.